I think I just started, maybe I just started, I don't know if it stopped recording or started again, but now we're continuing with the recording. So we really want with what we do is we partner with high-level general partners, real estate developers, and partner our money with them. What I have found is that there's two different ways to go about it. One is you can go and learn real estate. There are amazing people out there who can teach you real estate, teach you different things to do. And the other opportunity is to partner with somebody who has already learned it. So it just depends on where you want to spend your time. If you want to spend the time learning and growing in real estate, then by all means, there's a number of ways. There's wholesaling, there's um, flipping houses, adding ADUs, all the different things that we partner with people at. But with really what we help to connect people with is an opportunity to partner with people who have already learned it. So our vision is really to help raise or help other people make $1 billion. And so what I'm going to do is go through first a deal that just closed so we can kind of go through some of the different opportunities. So the main point that we're going to talk about today is income versus growth. So there are two different ways to look at it as we have our money working for us. So if we're looking at what is a passive income investment, a lot of people say, okay, let me buy a house, let me buy an apartment, and I'm gonna rent it out. Well, that's not actually passive if on Saturday you're going to fix a leak or a toilet, or I have a friend who owns a supplement company and he owns an Airbnb in Florida, and they're texting him at all hours of the night asking where the broom is. So it's not truly passive. And if our gift is in a different area, which some people's gift is in real estate, by all means, go and run in that. But if our way of creating financial abundance for ourselves may be in a different area, whether it's tech sales or business owner, or even a different area of real estate, then let's have our money work for us by partnering with people so that it's truly passive, where you just wire your funds and then the money goes out and works for you. So with the investment that we just closed on, what I'll go through is this Vista Meadows deal. So with this, we talked about income versus growth. So income is going to be something where I'm getting monthly income, quarterly income, something like that. So my experience, what we've found is that your income investments are normally, because it is lower risk, you're getting cash flow in each month, it's going to be lower amounts. So normally a lot of the opportunities that we're investing in are between 8 and 12% when we're talking about income investing. Then when we've got growth investments, those are normally, because to think about, normally some sort of development. Like this one is two luxury homes. So we're actually building for a certain square footage for a dollar amount per square foot, selling at a higher amount. Or we invested in a ADU deal here in San Diego. We built for 300 a square foot, sell for 700 a square foot. So what you're doing is there's more margins there versus, say, let me buy an apartment complex and renovate some of the units to make them nicer and add a little bit of rent to that. So it's just a different business plan. One thing to think about in real estate is people are like, oh, I invest in real estate. You're actually investing in a business that is tied to real estate. So the only difference between a real estate investment and a business investment is that a real estate investment normally has a physical asset. If you buy a business and it has trucks and different things, those are physical assets, and that's why the bank will actually see it that way when you're getting a loan there. But a real estate, whatever the strategy is, it is a business plan that then needs to be executed. So what we really facilitate is going and finding people who are very good at what they do. They have a set formula that they've already been executing. And so one of the filters that we look at is, I don't want to work with somebody who is learning a new formula. As somebody who flipped 17 homes in 2 years, we had a lot of school fees during that time when I was doing active real estate. We're now focused more on passive. But there were a lot of school fees that happened during that time. I would rather partner with people once they have already learned that. In the book Outliers, it talks about how to be an expert, you need to have 10,000 hours. Well, at 40 hours a week, 10,000 hours is at least 5 years. So we always look at that. So the first thing to look at when we're looking at an investment, so with this, what we do is this is Mylar Capital. They've been in business since 1997. Teed Up is the fund that we buy businesses with. This time we did real estate. So what we look at first thing whenever looking at a deal is who are the people. A lot of times we look at what is the return, what is that? Business is our people executing a business plan. So I first want to look at people because you think of when a business goes down, when Enron or any of these other things that have happened, it's always people making decisions that were out of integrity. When there's market downturns or different things like that, integrous people can still find a way to make a way out of it as long as they haven't made some really astronomical decisions. So I always look at people first. So what you have here is people who have been in it since 1997. So I'm looking at that. Then, and actually, one of our investors bought his first house from Gordon Mylar in the late 90s. So, needless to say, there was an extra level of trust when somebody who had invested with us before was like, "Oh yeah, I know Gordon and Dan. They came to my 50th birthday. I bought my first ever starter house from him." So what that tells us is, I mean, in 3 years, he will have been in the market for over in real estate in Utah in this area for over 20 years. So, or wait, 30 years. Yeah. So that's what we want to look at is, okay, one, who are the people? And so I know people who have done business with them. Also, Kirk Langson, the Teed Up, one of the partners has a air filtration company with them. So they've done business together. You learn a lot, just like in a relationship, when you do business with somebody, you get kind of a peek behind the curtain. So if somebody has been in business, done business with somebody, I always look at that. So the first thing there is to be able to look at people. Second is the investment. So I love that they have zero investment capital lost since their inception. They have over 40 million in active investor-backed projects. And then we look at returns. So there's one little error here on the PDF, but we'll just ignore that. So first thing is okay, so we looked at the people, then we look at the market, Salt Lake City. So let's go back up here so we don't get too distracted by the numbers. But Salt Lake City. So I like it. Some of us are from San Diego, some are from different areas. Supply and demand. We learned it in, economics 20 econ 206. I remember it my freshman year of college. Supply and demand. So if you're in an area that has a limited amount of supply, I bought in Mission Beach. It's a peninsula. There's a certain number of real estate. You can't expand the peninsula. In San Diego, we have the Camp Pendleton, we have national parks, we have Tijuana and the ocean. So there's only so much real estate, which is why ADUs are doing well because people are having to build and build more housing on the current land rather than say a Dallas or a Arizona where you can continue to build out or Denver you can continue to build out. So there's that. Same thing here in Salt Lake City. So they've been number one or number two. I think they're number one for the last 4 years in terms of the business economy in the state. So they're very business friendly there. So that's one thing to think about is how are the local politics when it comes to real estate. They're very business friendly there. And then the second is it's the same supply and demand. They call it the Silicon Slopes because it is in a valley. They call it a valley. And there is the mountains to the northwest of it. You've got Zion to the south and then mountains on each of the sides. So there is a limited amount of supply there. And the general trend is that people are moving there. An article, as we were looking at this, looked at, hey, they call it the Silicon Slopes now. They said, move over Denver, Silicon Slopes are the place to be now. So a lot of tech is moving to Utah because of some of the different tax advantages and job force that is out there, as well as people want to, as you see this remote work, if somebody loves to snowboard, loves to be in the mountains, but also can have a national park close, like you've got Zion and the mountains both there, it is a great place in that aspect. So then we look at returns, right? And these are the two most important things is when do I get my money back? Am I, if, because it's, hey, if I want my money to be back in a certain period of time, this may not be the right investment. When I first started investing, it was 5 to 10 year holds with a company called Horizon buying apartment complexes by universities. This is 10 to 13 months. Then there's a 33% IRR, so that's the return. And then you're looking at some of the dynamics there of the total square footage. With the basement, they're adding the ADUs. So these are some of the things that we look at when we're looking at a pro forma at a deck. Then we always want to look at what the financials are, everything that goes into the project. I don't want to go too deep into the numbers, but I can share this. I just wanted to be able to review what a deal that we invest in looks like and some of the main things to be looking at. So remember, this is a growth deal because what happens is the total project cost is 3,935,000, and then we can sell. They're looking at the appraised value, which I'll go down in a second. Um, we can sell between, let's see, it is 4.775 is where you see this amount right here, 33%, but the firm actually believes that they can sell for 5.2, which is where the 60% return comes in. So anywhere in between there, we're pretty happy with. It is development, so and it's real estate, so there's always risk, but because it is a shorter time frame, we are able to look at what those dynamics are. So the next thing to look at is what is the preferred return? And you're like, Daniel, I've never invested in one of these deals. I don't know what preferred return means. So think about it this way. Bank, so they got a private money loan for this. So this person, upon sale, they get their money first. Then second is the investors come in and they get the preferred return. So before Mylar, outside of any fees that they may have, before they get anything, investors get 12% back. So what that tells me is that that is lowers the risk in some ways because I know I'm going to at least get my 12%. And then you have a 50-50 return. And then normally what happens is once they hit a certain multiple or a certain amount, then it'll be more advantageous for the developer, which I believe in. Hey, if you knock it out of the park, you should get more money once it hits a certain equity multiple. So that's how that dynamic works. Then this is the overall area. We talked about macro of the area, look at what is the local place that we're investing in, as well as what is the environment. So this is Salt Lake City, South Salt Lake City. One of the dynamics here is there used to be a jail right here. They moved that out and they're putting that into now be a shopping center. So there's a lot of development going here. There's minimum acreage, which means it's a nice area. Whenever you have a minimum lot size, that does help to create that. So it's like a suburb of Salt Lake City in between Salt Lake and Provo. And then you've also got Zion down here in the south. So it's 2 lots, you're able to see that, and then some of the appraised value of what it looks like. So these are some of the things that we want to look at when looking at a deal. And I wanted to more go into this is an example of something that we invest in rather than going super deep into the deal. But those are some things to be able to look at when looking at an investment deal. The other aspect is, okay, this is a growth investment. Do I want to have all of my money in growth? Do I prefer income? What is it that we're looking for? So it really depends on people. So some of the first questions I ask is, hey, what is your investment time frame? Do you prefer income or growth? And do you trend towards real estate investing or business acquisition? I have some friends who prefer business acquisition because they understand business. When they look at it, they see that. So those are some of the things to be able to look at. When it comes to income, you're able to get those monthly emails, you get the returns there. So I find that it's actually good to have a mix of both. So when there are opportunities, I usually like to put some into income, some into growth, but it just depends on the time of life and what your risk tolerance is as well. So some people will look to, hey, maybe later in life, I've got a little bit of a nest egg. I just want monthly recurring revenue. I have a friend, Patrick, I call him first position Patrick. he had a couple real estate deals that I think may not have been as advantageous as he had initially thought. And so he's like, you know what? I'm just going to go low risk. I just want to increase my monthly amount. I'm going to keep my what I do for my main gig and then have everything else come in and just go for recurring revenue there. So those are some of the dynamics that we look at. We do have a couple opportunities that we're looking to invest in. There is a accounting company through Teed Up for a business acquisition that we're looking at. So with the Teed Up business acquisition, it's a little bit unique in that it is a higher return as well as income. So how it works is when we buy a business, like let's say a accounting company, it is the buy box or the pro forma of that is that we buy it. I'll use easy numbers. $10 million. We let's say we get a loan for 7 million. Instead of raising capital for 3 million, what we do is we do a partial seller finance. So it'll be 7 million. We'll only have to raise 8 million because 2 million of it are financed from the seller. So then what we're able to do is then from the profits of that business, which if it's valued at 10 million, it should be at least 2 to 3 million in earnings there. And then we're able to pay investors back in 2 to 3 years. So this accounting company, I believe, will be 3 years. So you get 33% paid out quarterly every starting at 6 months in, and then every quarter from there. The downside is it's an accounting company. It is a business. It's not tied to real estate. So in some ways it is more risky. So it really just depends on what business you're looking at, what the recurring revenue is. And I always like businesses that have monthly recurring revenue. We invested in a landscaping company and it's a bunch of residential vacation homes. So they need somebody to take care of it because they're gone with all of the things that go into it. With the accounting company, a lot of it is bookkeeping, which is a monthly recurring cost that people pay. So just looking at some of those things when looking at investing in real estate or investing in buying a business. And then we also have a opportunity with a industrial deal in Oceanside that I'll be sharing out, and that one is industrial flex space. So when you have an office building and you have storage in the back, like maybe a plumbing company or somebody who has to have large machinery or large trucks, they can't be in a office space next to some financial advisors. They need that flex space. So most of those properties are, or most of those commercial industrial flex space are totally rented out. So across the county, it's over 90%. So we'll go a little bit deeper into that one when we have that opportunity. But I really wanted to go into the difference between income and growth, really reiterate the goal of helping other people raise or make $1 billion and doing that through the community of saying, hey, we're going to go out and find the best deals out there. And then we're going to partner with people who are already experts, have already learned it. Like I see Kane on this call, somebody who works with Chris Luna is a powerhouse when it comes to ADU investing. Go and find people who have already learned it, are great at what they do, and partner our capital with their expertise, and then we all can win. And then one of the other opportunities that people don't always think about is that we also have, if you have worked in a corporate environment and have a 401k with a previous company, you can actually move that over to a self-directed IRA and invest in businesses or in real estate. And with a number of those, there isn't actually any tax implications unless there's something called UBTI, which I'll go into on a different one. But luckily, this Oceanside deal is all equity, so you don't have to think about UBTI, which is essentially if I invest through a self-directed IRA, if some part of that investment is using a loan, then I have to pay taxes at a certain tax rate for that percent, like if 70% is put into that. So I'll go into that another time. But I did want to open it up to questions. If anybody had any questions about any of these opportunities, or you feel free to put it into the chat or ask here.
Um, yeah, just to clarify, income investment versus growth investment. So income is where you're looking for cash flow, like monthly return quicker. Growth is you're gonna give it and leave it, and then you'll get a bigger chunk at the end of that investment. And you
Correct.
guys decide how long the investment is, or does the group decide, or um in that aspect of
Question.
growth, 5 years,
So just
10 years?
Yeah, so whoever we partner with, it's the opportunity. So example, Vista Meadows was 10 to 13 months. We invested with this ADU group, Momentum Capital. Those were I think it was a 20 estimated 20 months, so just under 2 years. So it's whatever we don't decide how long they're in their business plan, which is their real estate execution will take. So it could be, I mean, there was a wellness hotel that we were looking at, which would have eventually been income, but the true upside to it was whenever it would eventually sell. And so that was like a 3 to 5 year investment. And so it's a longer time period. So we don't decide, we go and find the deals and say, hey, this is something that we want to invest in, bring the community together, and then we all invest in the deal.
So is this community set up like it's not like fund to funds. You're kind of trying to create like a club, like a just a community where you're just coming together, you're making decisions, you're saying yes to this. But then when we give you the money, you're setting it up how? Like what is that actually?
Great
Or
question.
we're just saying we're handing it to the experts, to those people, and they're setting up all the legalities and handling that.
So it's more of a fund of funds. So we'll either invest as a fund in it, or we'll say, hey, we really like these people. And the fund, which is Connection Capital, will be what's called a co-GP on it, which if you're familiar with, or for people who aren't, when investing in a syndication or a fund, how it's regulated by the SEC, and how it works is you have a general partner, which is Mylar Capital. And if for this example of Teed Up, it's Mylar Capital and Teed Up, they're co-GPs. And then we as investors, I put 50K into it. I am now a what is called a limited partner. So I don't get any voting rights. I get nothing besides the fact that am an equity partner in it. And I get the returns that are specified. So great question.
Right. How do they get around the accredited investor rule? Like if they're, a syndication or they're putting it together, um, there have some rules, right? Where you have to have a certain amount of assets in your name or before you can
Yeah,
invest.
great question. So an accredited investor, just so that everyone understands, is over 200,000 is single income for the last 2 years, or over 300,000 joint, or over $1 million net worth. So you do need to be an accredited investor to invest in the fund. One of the things that I'll go into on a different call is I'm actually a advisor for a company called Pocket Properties. They're the first platform to be they have their what's called the Reg CF, so unaccredited investors can invest in funds. So they are I don't know, custodian might be the best word. The guy who actually is certified he went to school for to learn about all the different dynamics with the SEC and that. But essentially, you're on like even this Momentum Capital. They're going to have their fund 8 or 9, Momentum 8 or 9 is going to be a fund through Pocket Properties so that unaccredited investors can invest in those deals. So that is one of the downsides to it. It's unfortunate. I understand why, but it's also like, hey, I can go put $50,000 on red and bet in Vegas, and there's nobody stopping me. But if I want to create a revenue stream, an additional revenue stream, I'm not allowed to do it. So we can go into some of that. And the good thing is depending on the structure of the fund, ours is not because we do if it's a 506B, meaning that you can actually advertise or you can market to people outside of your network. You aren't allowed to have unaccredited investors. If you do, I think it's a 506C, then you can have up to 35 unaccredited investors, but they're specified as sophisticated investors. So if they've been through something like Kingdom 320, I've done that, then they can say that. But what that limits is that we can't go and talk to people that we don't know about investing in the fund. It has to be all people that you already know within the network. So the reason behind that is there, I think, some grandma or something invested all of her life savings and somebody took it and then they're like, we need to make sure this doesn't happen again, which by all means, that's a horrible story and we never want that to happen. But um, unfortunately, when one bad thing happens, sometimes rules are created that limit the rest of us. So that is one of the dynamics there.
Okay, that's good to know. What's your goal on, if anyone else has questions, make sure you guys jump in, but what's your goal on the number of investments that you want to do a year for your fund?
So we have a goal to do another 3 million for this year. So for this year, and then we'll ramp up each year to be able to get to that $1 billion. So we'll we're we're looking for another 3 to 5 million in opportunities for this year. We've got a couple different ones that Oceanside one, the accounting through teed up, and then it'll scale up each year so that within 10 years, we'll have that $1 billion made for other people.
Awesome. I love that.
Awesome. Well, does anybody else have any questions? And Tasha, did you have anything else I can go over?
Um, nope, not really. That's it. That's all I had written down.
Awesome. Well, everyone, thank you so much. We really appreciate it. We'll continue to have these calls. We'll go over different opportunities. We'll post what we're doing next. We're going to have everything from different opportunities, ways to invest through, a self-directed IRA. We're going to have a tax strategist of how to utilize um, different tax strategies so that we're not paying all of our money to the government and keeping more of that in our pockets to have work for us. So our goal is really to educate. And just like I had a rich uncle help me get into this type of real estate investing and now business acquisition, I want to be that for other people. So thank you guys for your time. And Tasha, thank you for your questions. Everyone, thanks for jumping on.
Thank you, Daniel. Bye.
Bye.
Thanks,
Thanks.
Daniel.